Here to help us with this conversation around the services sector, we've got Paul Gruenwald, S&P Global Ratings Chief Global Economist. Paul, thank you for being here.
Good morning.
Good morning. So this services data coming in and mirroring what we saw in a really tough economic moment for this country.
Yeah.
Does that lead us to any type of concern that's similar to that moment?
Well, we've been waiting for some time for the economy to slow down, and the surprises have been on the upside, even on inflation. So now we've got a couple of really soft prints, and the focus is going to be on the language coming out of the Fed. We've got a rate cut coming later this year, but they've been waiting for a series of numbers that show a clear deceleration of the economy. This is part of the story. So one number is not a trend, but if we get a couple of more prints like this, I think the rate cuts are going to come into focus.
And so, we brought up this question earlier. Is it a trend in the quantity of data points that we see, or the quality in perhaps the decline or the contraction that we continue to see?
Yeah, well, they're trying to put it all together, right?
Yeah.
They're really looking at financial conditions, which is confidence, it's lending rates, it's spreads, it's asset prices. So the whole thing together. Do they have the right policy settings now to guide the economy to 2% inflation and full employment, or are they going to need easier settings? If we get a couple more prints like this, that's a clear signal that they may start to ease off on rates.
Well, and you said in your own note here that the main risk on your base case scenario would be a drop off in either services spending or in labor demand. At what point, like how many data points would you see that were similar to this that would cause you to say, oh, that's a drop off versus the type of softening that we're looking for?
You're right. We've been in soft landing cap for a couple of years now, but the fulcrum of that, or the support to that, has been services spending and the labor market. So those are the two things we're watching. If we get a string of prints like this, that could call into question, but you're right, in the recent report for our credit conditions, we did identify that the main economic risk is a crack in this sort of solid labor market services demand we've been seeing. And this is not a great print today. We'll have to see if we get a couple of more like this.
Does this increase the odds of a rate cut coming sooner rather than later?
Yeah, it's one data point, but if we extrapolate from here, I would say yes. We're in the December camp now, but September, December is kind of 50-50. If we get a couple more like this, the Fed could potentially go earlier.
We basically only have a couple more readings, too,
right,
in order to really get a sense of what the Fed may do, even as Fed Chair Jerome Powell, speaking in Portugal, saying that they would need to see more in order to potentially put a cut in play here. In September, it seems like that's the highest probability at this juncture.
Yeah, market was kind of 50-50 last time I looked, but after this morning, I suspect it's drifted a bit. But remember, we've had kind of false starts before, and again, we're going to need some more evidence. Next move for the Fed is down. Question is when it happens.
Yeah, well, and it's interesting too because Chair Powell really did sound like he wanted to cut yesterday, right? He said the word progress at least 5 times from my word count. So,
well, we know the global cutting cycle has started, right? We've got the ECB, and we had Bank of Canada, Bank of England's probably next. But the Fed, the U.S. economy has been outperforming. Inflation pressure has been strong. So we need the economy to slow down, but we need it to moderate, not to fall off quickly.